Hello, let me introduce myself. I am Damai Melati, EPM 234122036 Class AKT 23A. Here I will explain about the types of financial reports, elements, and benefits. Here's the explanation. Financial reports are documents that describe the condition and financial performance of a company in a certain period. This report serves as an evaluation tool for various parties, both internal such as management and employees, and external such as investors, creditors, and regulators. In general, there are four main types of financial reports, namely income statements, financial position statements, balance sheets, cash flow statements, and equity change statements. Each report has an important role in providing information related to the company's financial aspects. The income statement records the company's revenues and expenses over a period of time to determine the profit or loss earned. The financial position statement or balance sheet shows the company's assets, liabilities, and equity at a specific point in time, reflecting the company's financial health. The cash flow statement contains information about the movement of cash in and out in operating, investing, and financing activities, making it useful in assessing the company's liquidity. Meanwhile, the statement of changes in equity explains changes in ownership due to net income, dividends, or other equity transactions. Each financial report has the main elements that make it up, namely assets, liabilities, equity, income, and expenses. Assets are resources that provide economic benefits to the company, while liabilities are obligations that must be fulfilled. Equity reflects the owner's rights after deducting liabilities. Income shows the inflow of economic benefits that increase equity, while expenses are outflows that reduce equity, such as operating costs and taxes. Financial statements have various benefits for stakeholders. Management uses them to evaluate performance and make strategic decisions, while investors use them to assess the profitability and risk of investments. Creditors rely on financial statements to assess a company's ability to repay its debts before granting loans. In addition, governments and regulators use them to ensure a company's compliance with tax and accounting regulations. In particular, cash flow statements are essential in assessing a company's liquidity and solvency. By understanding cash inflows and outflows, companies can better manage their finances and avoid the risk of financial distress. Positive cash flow from operating activities indicates that a company has sufficient funds to finance its operations and business growth. Thus, financial statements are not only a recording tool, but also an important instrument in more effective decision-making and financial planning. Financial reports also play an important role in increasing corporate transparency and accountability. By presenting clear and accountable financial data, these reports help build trust between companies and stakeholders, including investors, business partners, and the wider community. Transparency in financial reporting can also reduce the risk of fraud and data manipulation, which can be detrimental to the company in the long run. Therefore, many companies follow international accounting standards such as IFRS, International Financial Reporting Standards, or PSAK, Statement of Financial Accounting Standards, so that their financial reports are more credible and can be compared with other companies in the same industry. In addition, financial reports also help companies plan long-term business strategies. By analyzing financial reports, management can identify financial trends, evaluate the effectiveness of strategies that have been implemented, and determine the necessary corrective steps. For example, companies can see if they need to improve operational efficiency, reduce costs, or find new sources of funding for expansion. Cash flow statements, in particular, are very useful in ensuring that companies have sufficient funds to invest in business development without facing liquidity problems. Thus, financial reports are not only an evaluation tool, but also a basis for strategic planning and decision-making to ensure sustainable growth. That was the explanation of the types of financial reports, elements, and benefits. Thank you.